Hey everyone, Coach Investor back to another video for today. So let's talk about Enphase. Remember Enphase? Remember how the stock was trading at $78, $79 after it reported earnings? Solar Edge was also down after they reported their preliminary results, and well, the outlook wasn't that great. Remember how the stock crashed? Well, since then, Enphase is actually up over 50%. Of course, it got a nice little push as well because, well, the market is expecting some rate cuts next year. And with lower interest rates, demand for solar products, demand for what Enphase, what Solar Edge are offering should go up. Now in this video, I'll go over a couple of things that happened with Enphase, the financials, the valuations, but also a small reminder that there are still some issues within that industry. Now I first want to start off with all the announcements that happened after they reported earnings. So as you can see here, they reported earnings at the end of October. Since then, they launched IQ8 microinverters and IQ energy routers in Switzerland. They also launched microinverters in Austria, in Brazil. They did launch new commercial microinverters in North America, high-powered solar modules in Mexico, new home energy systems in Italy. They expanded distribution partnership in Australia, and then they expand its support for virtual power plants across the United States. So safe to say that they have not been sleeping. Now that said, looking at valuation, I've put here the 5-year mean compared to its current PE ratio for the next 12 months, EV to EBITDA, price to sales, and price to free cash flow. You can clearly see that still for EV to EBITDA and PE, we are still lower than its 5-year mean. But of course, right now the company is doing a bit worse than what it was before. That said, after they reported earnings, you can clearly see that we were pretty low here, under 20 times forward PE, so very cheap for a company that was also and is free cash flow positive. If we look at price to sales, that's basically the same as the mean. Price to free cash flow in the last 12 months, we are at 20.9 times compared to 72.1 times, which was their 5-year mean. But if the business is slowing down, if revenue is lower, if margins might get hit, then free cash flow will get hit as well. Now, if we're looking right now, it has a market cap of $16.87 billion. Year to date, it's still down 53.2%. If we look at what the analysts are expecting with regards to their price target, so the average price target sits at $114.19, which means we are now 7.8% higher than the average price target for the next 12 months. Now, what are the expectations for the next 2 fiscal years? So in fiscal year 2024, sales growth is expected to decline 14.5%. EPS is expected to decline 4.2%. But in fiscal year 2025, we can see a reacceleration in growth for sales that should be up 36.5% year over year, and EPS should increase 43.5%. Of course, it all depends on how this market, this industry will react to the rate cuts and whenever those rate cuts will actually happen. Now, there is also one extra thing that could boost demand for this company. We're going to go into that in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the links down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first up, a quick reminder of the third quarter earnings. So revenue came in at $551.1 million. That's definitely much lower than Q2, which was $711 million. But gross margin here on a GAAP basis was 47.5% compared to 45.5%. This includes the benefits of the IRA credits. If we look at net income, that has also decreased quarter over quarter. Basic EPS is also down, and the same goes for diluted EPS. Now, the big issue here was obviously guidance. So revenue was above $500 million. For next quarter, they're expecting revenue to be in the range of $300 to $350 million. So again, a huge hit here. GAAP gross margin will be a bit of the same with net IRA benefits. Without the net IRA benefits, we should be sitting at 38 to 41%. Non-GAAP is the same thing as we were this quarter, or around those numbers. So again, the problem was revenue, the guidance. Guidance was extremely weak, and this is already the second quarter in a row where guidance goes down, where revenue comes down lower than the previous quarter. This remains an issue until there is a more positive sentiment in that industry. Now, what could boost demand is this. So apparently SolarEdge and Enphase Energy are likely to receive bigger tax credit than previously estimated from the US Treasury proposed rules issued on Thursday. This is according to an analyst at Citibank. The guidelines are meant to stimulate US output of clean energy products. So SolarEdge and Enphase appear to be able to manufacture components in the United States, get credit, and export the good outside of the United States, so they can earn more credit than anticipated. This could also mean that their US manufacturing facilities may be able to run at a higher utilization than previously thought, which could provide margin upside. The tax credit for advanced manufacturing, known as 45X, rewards businesses that make key products in the United States. The credit's value is related to different parts of the clean energy supply chain. And if we go to that announcement right here, so this was released December 14. US Department of Treasury, IRS released proposed guidance to continue US clean energy manufacturing boom, strengthen America's energy security, because right now China is literally dominating in that area. So I want to read you this. So under President Biden, businesses have announced investments of more than $600 billion in clean energy and manufacturing, with more than $140 billion announced for the manufacturing of clean energy technologies, electric vehicles, and batteries since the president signed the Inflation Reduction Act. By the way, in that Inflation Reduction Act, there's a lot of extra things in it. That's why most bills actually have hundreds and hundreds of pages, because, well, you can put things in those bills that nobody will read, but the headlines do look pretty positive, which is exactly what has happened here, which, by the way, is a positive thing because this creates jobs, this drives the cost of clean energy in America down, should be the same thing in Europe, etc., etc. So there's definitely a lot of positive things coming out of that bill. Now, that said, like we've talked about in the dividend video, companies like ExxonMobil, oil companies, are still of extreme importance in today's world. Most of our products are made thanks to these fossil fuels, let's call it. Don't forget that. Now, if we go and look at the graph for Enphase, we can see that this week, past week, we have broken out of that downtrend, which we've been at since late last year, basically 1 year ago. As you can see, this was the bottom, so it would seem after the earnings report, we traded at around $80 or so for 2-3 weeks, and then we rebounded from there. We went over the 20 and the 50-day moving average, so we were up 54%. The 200-day moving average currently sits at around $145 or so, but 120, 125 could be a resistance if we do not keep up with that momentum right now. Remember, just because the stock is up 54% doesn't mean that the business has changed much, because since then we didn't have a new earnings report. We didn't have a new guidance from the company. So just the market sentiment has changed, has turned a bit more favorable towards these types of companies. And yes, maybe it's true that at $80, it just didn't make much sense. It was peak fear. These companies were not going out of business. This industry was not going to disappear either. But now that we're back basically at the same price we were before they reported their latest earnings report, maybe it's time to, if you traded it, maybe it's time to take profit. Maybe it's time to wait for a better opportunity. I'm not saying you should short this stock right now, but rationally speaking, these companies have gone back to the same valuation they were before they reported extremely bad and worrying earnings and guidance. So yeah, despite a positive outlook for 2024, maybe we should be waiting for a better entry point. A month and a half from now, of course, we are going to get the Q4 numbers and guidance for the quarter after that. That should tell us way more than what we've got right now. So that will be it for this video. Again, Enphase, SolarEdge, they're operating in an industry that will continue to grow. There are certain leaders in that market. You're going to ask me, why don't you own Enphase? Why didn't you buy? Well, like I said, I own Tesla. Tesla is also a very big player in the energy segment here, so I'm happy with that. But definitely Enphase will benefit from rate cuts, from more demand for these types of products, and definitely from the positive effects from that Inflation Reduction Act. But remember, the stock is up 54% and nothing has really changed with the business. The same can be said when it's the other way around, right? When the stock is down 54%, but nothing has changed with the business, then we start acting differently. Just remember, congrats to all of you that have bought at $80. And for those that said at $80, I'll wait for $40, $50, well, sometimes you need to be greedy when most people are fearful. That will be it for this video. Do share your thoughts down in the comments below. Have you been adding, selling? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.